Good day, students. Welcome to lesson 73. In this lesson, I will be marking exercise 5A and exercise 5B. Okay. So we've learned that the cash flow statement, the first part of the cash flow statement is the cash effect from operating activities. That is the first part that we need to calculate. Okay. How we do that? We start with cash received from customers, which is obviously an inflow of cash. Okay. And how we do that? How do we calculate the cash received from customers? We are going to start with sales we get the sales amount from our income statement. Okay, so you can see that I got that sales amount from the income statement. I've marked it in pink so that you can see the 900,000 where I got that amount from on the cash flow statement. All right. The next amount that we are going to use is discount allowed, but there was no discount allowed on the income statement. So that is why that amount is 0. And then the other amount that we're going to use there is bad debts. Remember, I've explained to you why we deduct discount allowed and bad debts from sales. Okay, so the amount for bad debts is 3,000, which I also got from the income statement. You'll see I've marked that the 3,000 in yellow on the. Okay, so now we are going to add trade and other receivables at the beginning of the year, which was 160,000, and we're going to deduct trade and other receivables at the end of the year, which was 340,000. Right. Then we're going to add other income. Under other income, we add interest received, rent received, and commission received. In this case, there was none of these. There was no interest received or rent received or commission received. So that is why that amount is 0. Okay. So then we're going to add up the 900,000 for sales. We're going to deduct the bad debts of 3,000. We're going to add the trade and other receivables at the beginning of the year of 160,000 and deduct the trade and other receivables at the end of the year, which was 340,000. And then if we do that calculation, we get to an amount of 717,000, which was the cash received from customers. Okay, so the next item that we need to calculate is the cash paid to suppliers and employees. Right, how do we do that? We start with purchases. In that calculation, we are going to calculate the total purchases. In other words, the cash and the credit purchases. But as I've explained to you, we will do a correction on that amount by adding and subtracting the trade and other payables. All right. Okay, so let's start with purchases. We're going to start with the cost of sales, which was 280,000. I got that amount from the income statement. We're going to add closing stock of 118,000 and deduct the opening stock of 125,000. Those two amounts we get in the balance sheet. Okay, then we are going to add trade and other payables at the beginning of the year, which was 328,000. And we're going to deduct trade and other payables at the end of the year, which was 336,000. And then we are going to add other payments. Remember now, we're not going to add depreciation, interest on borrowed money, and loss on sale of fixed assets. I've already explained why. Okay, so the payments or expenses that we're going to add here is for water and electricity, that was 55,000, and salaries or wages, which was 109,000. If we add those two amounts, we get 164,000. Okay, so now we can just add up these amounts. The cost of sales, closing stock, opening stock, the trade and other payables at the beginning of the year and end of the year, deduct that and add other payments, and we get to an amount of 429,000, which was the cash paid to suppliers and employees. Okay, so now we get to part 2 of the cash flow statement, which is the cash effects of investing activities. Okay, we're going to start with the purchase of non-current assets. Where do we get that amount from? We get that amount in the notes to the financial statements. Okay, so you'll find that it was 365,000 was the purchase of non-current assets. In other words, that was the amount that we get that. Let me just get that from the notes, which you got under the note numbers, the second note, note number 2, and it was under additions at cost. So you'll find there the amount of 365,000. Okay. And then the second item is the proceeds from sale of non-current assets, which was an inflow of money. Remember, okay, the first one, purchase of non-current assets, was an outflow of cash because it's money that we paid for current assets. That is why the 365,000 is in brackets. Now we get the proceeds from sale of non-current assets, which is an inflow of cash in the business. How do we get that amount? It's a 32,000, but how did I get that amount? Also in the notes, you look at the carrying value, the disposals at carrying value, which was 12,000. And remember, I said you're going to add the profit and deduct the loss on sale of fixed assets if there was a loss. In this case, there was only a profit of 20,000. So that is what 20,000 is added to the 12,000, and that is where I got that amount of 32,000. That is where I got that amount of 32,000. There was no loss in this case or in the income statement, so there was nothing to deduct from that. So that is where I got the 32,000 from. Okay. If we add those two amounts, then minus 365,000 plus the 32,000, you will get an amount of minus, in brackets, an amount of 333,000. And that is the total for the cash effects of investing activities. Okay, now we get to the last part of our statement, of our cash flow statement, which is the cash effects of financing activities. And we're going to look here at the non-current liabilities, which is a long-term loan. And then we will see that the long-term loan, it was like the beginning of the year, it was 350,000 and it is now 560,000, which means that we borrowed another 210,000, which means there was an inflow of cash of 210,000. Okay, so that is the total then of our cash effects of financing activities. Okay, so the last thing that we need to do is just to add our cash effects from operating activities, cash effects of investment activities, and cash effects of financing activities, and then just to see if that amount corresponds with our change in cash equivalents between the beginning of the year and the end of the year. Okay, so what was cash effects from operating activities? That amount was 138,000. We add the cash effects of investment activities, which was a negative amount. So we deduct the 333,000 and we add the cash effects of financing activities, which was a positive amount of 210,000. Okay, if we do a calculation of those three, if we add those three amounts, we get to an amount of 15,000. Okay, now let's see what happened with our cash and cash equivalents from the beginning of the year to the end of the year. At the beginning of the year, the cash and cash equivalents the amount was 513,000. The end of the year, that amount was 528,000. And if you deduct the smaller one from the bigger amount from the smaller one, or the smaller one from the bigger one, you get an amount of 15,000, which is exactly the same as the amount that we've just calculated, which was the total effect of the operating activities, investment activities, and financing activities. So we can see that our calculation was correct. Okay, I'm going to start now with exercise 5B. Okay, so part 1 of the cash flow statement is cash received from customers. So we start with sales, and that is we get that sales amount from the income statement. Okay, then we deduct discount allowed if there was discount allowed, and bad debts if there was bad debts. In this case, there was no discount allowed, so that amount is 0, and the bad debts was 23,300. If you look at the income statement, you'll see where I got those amounts from. The amount for sales was 1,629,800, and the amount for bad debts was 23,300. So you see there is no discount allowed in the income statement. Okay, so now we are going to add trade and other receivables at the beginning of the year, and we're going to deduct trade and other receivables at the end of the year. And both those two amounts we get in the balance sheet. If you look at the balance sheet, you'll see that the amount for trade and other receivables was 0, and the amount for trade and other receivables at the end of the year, at the end of the year was 384,500. Okay, so we're going to add those two amounts under cash received from customers. Okay, so the last item under cash received from customers is other income. And remember, I said to you, we're going to add income like commission received, rent received, interest received, and also interest on overdue debtors. All right. So if we look at the income statement, you'll see there was an amount for interest on overdue debtors, and that amount is 20,000. So we're going to add the 20,000 here under the cash received from customers. Okay, so now we are going to add the amounts under cash received from customers to get that total. So we start with the sales, which is 1,629,800. We deduct bad debts of 23,300, deduct trade and other receivables at the end of the year, which is 384,500, and we add the other income, which was 20,000. If we add those amounts, if we add it up, we get to an amount of 1,242,000, and that is the total amount for cash received from customers. The next step is to calculate the cash paid to suppliers and employees. Remember, we are going to calculate the total purchases, and then we will do a correction on that amount, on that account, or on that amount. Okay, but we'll get to that later. Okay, so we are going to start with the cost of sales. The amount for cost of sales, we find that amount in the income statement, and that amount is 834,700. And then we add the closing stock, which we get in the balance sheet, that is 123,600, and we deduct the opening stock of 586,000. Okay. If there was discount received in the income statement, we would have deducted or subtracted the discount received. Yeah. All right. Okay. And the next step is to add trade and other payables at the beginning of the year, which we also find that amount we also find in the balance sheet. That was 156,000. And we deduct the trade and other payables at the end of the year, which was 157,400. 157,400. Okay. Then we add other payments or other expenses. Remember those items or those expenses that you must not add here. I've said that many times before. Depreciation, interest on loan, and then loss or profit on sale of fixed assets. We don't add them here, as I've already explained to you. Okay, what are the expenses that we're going to add here? Water and electricity is 74,100. Wages and salaries is 121,600. And sundry expenses is 13,600. Those three amounts added up give us an amount of 209,300, which will be added to the other amounts. So we are going to add the amounts under cash paid to suppliers and employees. And if we add those amounts up, we get a total of 580,200, which we will enter in the cash flow statement under the cash effects of operating activities under cash paid to suppliers and employees. Okay, but remember, those amounts represent an outflow of cash because it's money that we paid to suppliers. It's an outflow of cash. So that amount will be written in brackets. In others, we will subtract that amount. We will deduct that amount because it's an outflow of cash. And then we get to the last step or the third part of the cash flow statement, which is the cash effects of financing activities. And remember, under this heading, we work with loans, long-term loans that the business, if the business made a long-term loan or got a long-term loan from the bank, we will enter this here. And also if the business has paid back the loan, it will also be indicated here. So in this case, let me just see. Okay, so now let's look at the balance sheet to see what happened with our long-term loan. Okay, if you look at that, you'll see at the beginning of the year, the long-term loan was 1.5 million, while at the end of the year, it was only 1 million. So what does that mean? It means that we have paid back 500,000 of the loan during the year. So for that reason, we will enter under this payment of long-term loan, we will enter a 500,000 and it will be in brackets because it's an outflow of cash. Okay, so that 500,000 is that, or the minus 500,000 is the only entry under cash effects of financing activities. Okay, so that we've got the three totals now for our cash effect of operating activities, of investing activities, and financing activities, which we're just going to add. It's the operating activities total is 371,800. We're going to add the cash effects of investing activities, which was 118,300, and the cash effects of financing activities is a minus 500,000. If we add up those three amounts, we get to an amount of minus 9,900. And just to check if our calculations were done correctly. We are going to see what the cash and cash equivalent was at the beginning of the year and what it was at the end of the year. Okay, on the balance sheet, you can see what the cash and cash equivalents was at the beginning of the year. It was 48,000, and at the end of the year, it was 38,100. So it means that the cash has decreased with 9,900. If you take 48,000 less 38,100, you get 9,900, and that is the amount that our cash or that the business's cash has been decreased. So then you can see that your calculation was correct with that 9,900, the amount that you got after adding the cash effects from operating activities and investing activities and financing activities.